with all of that. Well, the market's down about 60 points, so nothing new in that sense, but lots of stocks moving around, which we'll refer to. 18,100. On to our special segment, Quarter Se Quarter Tak. Nigel has walked across to the big wall, and we're going to talk about expectations from the steel sector in the third quarter. Nigel, over to you.
Well, the ferrous space will get some shine back, but not glittering as yet. That's for the third quarter. The steel sector earnings, they have fallen considerably after peaking out in the second quarter of FY22. That's because a combination of factors: weak demand, weak pricing, as well as higher coking coal costs. Now, after a gap of 4 quarters, the estimate is that the sector EBITDA per ton will finally start showing some improvement. Well, let's run you through the key factors at play for the ferrous industry. Realizations, they're expected to decline by around 2 to around 3% odd on a sequential basis. That'll be roughly around 1,500 rupees per ton sequentially. That's led by price cuts as well as contract resets during the past quarter. Raw material costs, well, they'll cool sequentially, which will aid non-integrated players in particular to a large extent. Coking coal costs are expected to decline by around $80 to around $100 per ton, while iron ore costs can decline by around 500 to around 750 rupees per ton. The volume growth is estimated at around 13% on a year-on-year basis during the quarter, led by a low base despite weak exports. There will also be close to around a 4,000 rupee per ton quarter-on-quarter recovery in steel margins in the third quarter, but it will still be almost half at what it was in the same quarter last year. On an EBITDA per ton basis, well, JSW Steel will deliver the biggest jump on a sequential basis, followed by SAIL, Tata Steel, as well as JSPL. But Tata Steel Europe, well, they'll struggle. They expect to report a loss led by a significant drop in prices as well as weak demand. That's what will impact their product mix. Valuation-wise, well, should come up for you on the screen, but as we know, the EBITDA part of that business, well, that fluctuates. Hence, there'll be greater focus on the price to book value, which for ferrous names, well, the price to book value is pretty much in line with what we have seen in the past averages. For metals, we know that momentum is more important. Moving ahead, the most critical element will be China reopening and also the Chinese government stimulus. That's what could aid the real estate sector out there and in turn aid steel demand. Coming back home, well, the pickup in domestic demand will be tracked as restocking takes place. Additional volumes can improve as export avenues reopens, while prices are higher as well. But some part of that price increases, well, they'll be offset by higher raw material cost as well. To help us understand what do we expect from the sector in the coming quarter, well, we have Amit Dixit, analyst at ICICI Securities, who joins us. Hi, Amit. Thanks so much for joining in. Well, before we get to the quarterly expectations, wanted to ask you, what is the current price difference between imported steel and domestic steel? I understand there have been a couple of price increases in the last 2 months here in India. Go ahead.
Yeah, so if you look at the price difference with respect to China, we are at 5% discount. With respect to South Korea, particularly after Nippon Steel has increased prices for March deliveries by a hefty $150 per ton, we are again back at discount. So clearly there is an element of discount of around 8% over there. So there is definitely a headroom for domestic players to increase prices, provided demand in domestic market sustains.
Okay, all right. So some kind of cushion for the domestic players. I recall in November, we were at a premium. So there is a discount, then it gives some scope for price increase. At least we can hold on to these levels. Well, Amit, I wanted to ask you about your preference from the ferrous space itself. We have 4 large listed players. We have a brokerage note today coming in from another sell-side brokerage, which believes that SAIL is well placed. For you, from the top 4, what is your preference out there, and tell us why?
Yeah, so our clear preference in the sector is JSPL. We have a buy only on JSPL out of 4 major names. Rest are either hold or reduce. And the reason being that, see, we go by the cost, first of all, the cost. The second is in terms of demand, what we believe that longs typically will fare well in the fourth quarter, and there we see demand creeping up. So definitely JSPL is well placed. As far as SAIL is concerned, well, from the risk reward perspective, we don't see much benefit over there. Although I would say that the higher iron ore cost in the country would definitely benefit integrated players like SAIL and Tata Steel. But given the fact that coking coal prices have started rising up, and this typically impacts sale more than the other players. So in fact, in the period we were talking about, from October till now, coking coal prices have risen from $240 to $300 a ton, and that would progressively get reflected in the P&L. So as a result, the spreads of companies like SAIL might not materially improve despite the improvement in prices that we see over here. On the other hand, JSPL is like it is dependent for part of its capacity on the thermal coal, as well as they have a natural hedge for coking coal from their own mines in Australia. So there we see the benefit a little bit more.
Okay. Since you do believe that there is headroom for domestic prices to go up, as well as, perhaps demand is also picking up, on JSW Steel, what are your thoughts? What kind of upside do you see in the near term, and what are the triggers?
Well, as far as JSW Steel is concerned, see, provided if the domestic demand picks up, this company is best placed. The reason being they have a spare capacity. However, two things here. One is that I think we are being too optimistic on China at this stage. It all depends on how the policy pans out after Chinese New Year. And moreover, if you look at Chinese indicators, look at housing starts, look at the new area purchased for sales, or even look at the aggregate financing numbers, these were lower than expectations. So clearly, for any policy to sail through, it will take at least 3 to 6 months. So my point here is that the global factors might not play out as people are expecting. The second point that goes against JSW, unfortunately, is the high level of debt, relatively high level of debt. So if prices were to slide from here, I mean JSW would be a disadvantage. And the third and the final thing is that in case of JSW, we also see valuations. I mean, they are at an absolute high if you compare to the other peers, as well as its own trading average over last 10, 15 years, whatever time frame you take. So we believe from a risk reward perspective, things are not that, I would say, attractive over there. But at the same time, in terms of EBITDA growth, well, the company can show EBITDA growth because it has got enough headroom to ramp up volumes.
All right, Amit, just moving a little away from the ferrous space, I wanted to ask you about, the stainless steel place. And you have been quite positive on JSL and JSL Hisar. The stock has seen a big run from the recent lows. How much of it is already in the price? Are you already considering the merger, in the numbers that you've put in?
So the numbers we cover only JSL, so the numbers are not with the merged entity.
Okay.
However, what we believe that the merger, the benefits of merger, I think some of it have or are already priced in the stock. The second big benefit, though, that people often choose to ignore is the acquisition of the stake in JUSL. I believe that will bump up EBITDA per ton by roughly 3,000 to 3,500 rupees a ton. And since we are talking about JSL, I would expect actually EBITDA per ton springing back again to 18,000 from 15,000 odd in last quarter. So I think that is positive. And then we also expect sales volume to be at around 285 KT, led by the inventory that was built up in last quarter. So clearly these are the highest volume ever. And we believe that in case of JSL, there is another upside for at least 15 to 20% hike from here. And then if you look at the merged entity, the benefit with JUSL, some of it will pan out, of course, in FY25. I believe you have got pretty good headroom over there.
Okay, I wanted your thoughts on APL Apollo as well. A lot of brokerages recently raised their earnings estimates and target prices on the stock. There's also their Raipur plant that will start contributing now. So are you optimistic here, and what kind of an upside do you see in the near term?
Yeah, so as far as APL Apollo is concerned, we believe that EBITDA per ton will come back to 4,000 rupees a ton in this quarter. Their sales volume was like an all-time high in this quarter, and more importantly, the product mix that we observe has become richer. courtesy Raipur plant stabilizing and ramping up. We believe that this particular plant, which has capacity of 1 million ton, as it will stabilize and ramp up in the quarters to come, the product mix will get even more richer, and therefore EBITDA per ton will creep gradually to around 5,000 rupees a ton. A key critical factor is that the acceptance of larger diameter pipes in the market that the company produces, and the Raipur plant definitely produces that kind of a product. So we would wait and see the kind of acceptance that happens for these product. But overall, we are quite positive on the stock. One thing very positive from the stock perspective is that it is a downstream player, so relatively immune to the movement in the HRC prices because it's a kind of converter business. So that gives us additional comfort.
Okay, Amit, final question then, not a company specific, but more sector specific. The rebar prices are trading at a premium in comparison to HRC. You expecting this to sustain? And, what should the normal level be, the difference between both these two?
Yeah, so historically, what we have seen that the difference between Rebar and HRC has been around 4,000 rupees a ton, give or take few hundred rupees here and there. And HRC has traded at a premium. The reason why Rebars are trading at a premium there are two reasons. One is that, as we all know, Hockey World Cup is happening in Odisha. So the lot of sponge iron facilities have been actually shut down for the month of January. And therefore, this provides impetus to secondary rebar prices, which is also reflected in primary rebars. That is point number one. Point number two, we have seen rebar prices sustaining for quite a good period of time. The reason being that the demand is more local in nature, while in case of HRC, prices are pegged to international markets. Having said that, international prices in HRC have moved up by almost 15 to 20% since November. So HRC will play a catch-up game. And we expect that as Q4 flows, we expect that this thing to normalize by Q1. And rebar prices, while they will increase, the increase could be lower than case of HRC, and there could be a discount of roughly 2,000 rupees a ton between HRC and rebar.
That's interesting. I mean, hockey in Orissa and rebar prices. I mean, the connection.
Yeah.
Thank you very much. Interesting conversation. Interesting listening to you, Amit, as always. Thank you for joining us.
But very good point, actually, by Amit, because normally the HRC prices trade at a premium comparison to the bars.
Yeah.
Bars are used more domestically for construction, etc. But suddenly, it's flipped around. And now you have rebar prices that are trading at a premium. Many years, I've never ever seen this. So good logic out there. Some of those sponge companies, they have shut